Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. What an amazing pocket of time. This continues to transpire in the course of 2022. We go back to last week. We have the Fed meeting. The buzz and our weekly centers around this notion of neutral, not too hot, not too cold. If you look at our star, where the Fed looks to look at real Fed funds rate, call it 0.5, 2% inflation target, call it 2.5, which is in their summary of economic projections. No, it's interesting. I mean, we're not making light of neutral necessarily, but what does it really mean? And certainly the Fed has referred to this specifically too, that they don't really know exactly where neutral is. You go back to 2018 for context, and we were calling neutral the same place that we have it right now, in and around 2.5%. And you had core PCE, the Fed's favored measure, and Powell does refer to this in his presser from last week in terms of CPI versus PCE. They do prefer PCE, but they understand the American people certainly look at CPI in terms of mainstream. They had neutral in and around the same level it was. Core PCE was in between 1.5% and 2%. Friday, we had a 4.8% print. So we think neutral is higher than 2.5%. We call it 3%. The Fed has said they want to go into restrictive territory. The chairman last week referring to the SEP from June, saying that he doesn't think that is stale, getting to call it 3.4 and then 3.8 in 2023. We're not priced for that. We're priced for this up scenario, and even the terminal rate has come down now in and around 3.25, and then we're lowering rates in 2023. But if you look at the rate structure right now, I mean, there are certainly disparities. If you look at what the Fed is calling neutral relative to what they called it back then, if you look at a 3% neutral rate and then saying going into restrictive territory, you're looking at a Fed that very well could move to 4, a little north of 4, and then incorporate the balance sheet runoff with that. And then you look at where core inflation is, and that gap fills in a little bit. It makes a little bit more sense than looking at this 2.25 to 2.5 and close to 5% core PCE inflation and thinking the Fed is going to be successful. Now, with that said, you look at the market pricing right now, you look at coming out of the meeting, we had Kashkari, Minneapolis Fed President Kashkari over the weekend saying that he thinks the Fed is a long way from bringing inflation down, getting back down to that 2%. So we do expect some of the Fed speak to fill in here. One of the more constructive things that we did think came out of last week's meeting is the Fed going to full data dependence, which is necessary. No forward guidance. The 50 times 2 turned into 75 times 2. And in reality, we just don't know. These inflationary numbers continue to come in hot. On the positive side, inflation expectations have come down, and that's to the credit of the chairman and the Fed for projecting their hawkish stance here going forward. And we do continue to think that they will continue to have some wood to chop here. There are more rate increases to come. The chairman certainly alluding to the fact that they could slow down the pace of those increases. And it makes sense. We have growth versus inflation. Our bearish calls of 2022, we tempered in May of 2022 with a more two-way dialogue in terms of fixed income and looking at the treasury market in and around the 2018 highs in nominal yields, with this notion that the dialogue would become more thoughtful. And we do think the dialogue is becoming more thoughtful, and we are hearing that from the chairman. But having said that, more thoughtful doesn't mean the Fed is going to actually stop. So whether we peak at 75 basis point increments, come back down more toward 50 basis points in September, which is plausible, although 75 basis points is still on the table. Everything is on the table, depending on how the data evolves. We are truly data dependent at this point. It's warranted. We are lack of forward guidance, which is clearly warranted. And from our perspective, we wouldn't get too caught up in this notion of neutral at 2.25 to 250. We still feel the Fed has more wood to chop here. On the ground this week, very busy week. Again, all about the data. We had ECI and the PCE coming out of Friday. This week, certainly we get the ISM numbers, which have been, the PMIs globally have been weakening. We get manufacturing, we get services, we get another JOLTS report, and the vacancies to unemployed, that ratio is certainly front and center. We get another claims number, claims now being watched very closely here in all of the discussion and dialogue. At last week's presser from the chairman, every time he was asked about recession, the answer was unequivocally 100% pointing to the job market, which certainly puts more emphasis here on the job market going forward. Not that the Fed is going to stop again, but do they temper and pull back from those extreme 75 basis point increments? This Friday, we get another jobs report, which will be front and center. Wishing everyone a great week ahead, great summer weeks here, great summer weather. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.